we upgraded Europe relative to the US today. Europe is now an overweight in a global allocation, and that's partly because in the last couple of months there's just been a small suite of incremental negatives. The potential for a ceasefire in Ukraine, and we can think about how that passes through the economy. Less fiscal contraction in France, potentially fiscal expansion in Germany. A variety of things that are starting to stack up that investors are starting to price as potentially producing a better earnings growth environment. So expectations in Europe for growth are now about 6% and stable, which is a change because they've been downgraded through the second half of last year.
You're saying there's more upside on European indices,
well,
even though we're at records on some of the markets now?
Well, this is the fantastic question. So from our macro modelling perspective, Europe has now caught up to where it should have been a month or two ago. And the US market is a little bit elevated to where it should be. So the question is, if there is relative outperformance of Europe, which we believe there is it going to be driven by European upside or US downside or both? Personally, I've got a little bit of a preference. The US might be a bit vulnerable, particularly with Mag 7 earnings starting to roll over. But there's certainly plenty of momentum and enthusiasm in Europe that I don't think has been fully backed by regional allocators with large amounts of money that are generally neutral to underweight Europe and have been feeling that pain, and typically heavily overweight or at least neutral in the US. And so just the weight of money might push things a little bit further yet. And obviously the soft data has been suggesting that we will see an economic improvement. Hopefully we see that in the data as well.
One big headwind could be tariffs and Trump. We're still seeing negotiations play out, and we're talking about sectors that are loved by investors, pharmaceuticals, and unloved by investors being autos. What is the impact if we do see some trade tariffs on the scenario as you upgrade?
Yeah, it's really interesting. In our analysis, the complication with tariffs is that they're highly redistributive, and you're not quite sure who the winner and loser is. Is it the importer or the exporter or the consumer or the government who's paying the bill? And so you get these quite wide range of outcomes for what the tariff scenario we're forecasting might produce to GDP and growth and inflation. So in the US, it's more likely a stagflationary impulse, lower growth, higher inflation. But in Europe, it's more of a recessionary impulse, just lower growth without any material impact on inflation. So it's going to be very interesting. It's much more of a stock-specific, maybe a sector-specific story. You can see consumer services dramatically outperforming goods in the US because of this potential tariff concern. A little bit of that in Europe with the tariff losers baskets being much weaker than the market in the last few weeks. But we just don't quite know yet where the dust will settle. It's probably not particularly macroeconomically important unless we start thinking about confidence effects, and we'll see that in the PMIs in the next week or two.
You were raking over some of these key sectors before the election and what the tariff implications would be on consumer discretionary, autos, tech, food. The problem for me is we see earnings cross. It's very stock specific. I mean, even today, the bifurcation of Nestle versus Unilever. So what do you do in that scenario? Is it the only way is to go drill down to the individual names? Is that the only way to play this trade?
Well, it's a very high alpha environment. A lot of the sector performances can be reasonably correlated, but the sector divergences can be reasonably significant. So what definitely has worked, we've got a framework that covers how stocks behave and sectors behave through the business cycle, earnings, valuation and sentiment. And what's clear is that the earnings momentum is a really important factor in Europe. So about half the market at the moment is being upgraded in earnings expectations. That's things like telcos and lots of the consumer sectors, some of the industrials as well, utilities as well. So we do like consumer, utility, telcos, capital goods, but a decent amount of the market is still experiencing downgrades as well. So there's an offset. But at the sector level, you can get quite a lot of information out of earnings momentum. And then with our very good crowding data, you've just got to be mindful that, especially in Europe, where there's a large concentration of sort of pod hedge funds, you can get crowding that gets to a point that sort of falls in on itself every now and then.
Any missing trades we haven't mentioned with you?
No, I mean, from a stagflation trade, the gold miners have been performing very well, and we expect they will continue to do well. That's more in the US. But particularly at the moment, the weakness of the utilities and the strength of the cash flow of telcos means that shifting a little bit more defensive in Europe is probably where the potential outperformance and potentially absolute performance of Europe is going to come from.